Hello, and welcome to this week's webinar. Today, we're going to be talking about dollar cost averaging. What is it? How do we factor that into your financial plan? And how can you do it as a court reporter to really maximize what you're already doing and the saving that you're already doing within your financial plan? So let's get started in today's webinar and talk all about dollar cost averaging. All right, so diving in here to dollar cost averaging, first and foremost, we need to know what is dollar cost averaging. So what is it? Basically, the way that the strategy works is that instead of trying to time the market and pick when you want to throw your money into an investment strategy, whatever it might be, really any investment strategy, it's always a tough decision of, is today the right day? Is tomorrow the right day? When do I actually dump this money into the market? And so that could be one side of it. The other part could be trying to time the market, where you're trying to wait for the most opportunistic time to add this money into your portfolio. So what dollar cost averaging is instead of trying to dump your money into the market all at once, we actually spread it out, and we spread out the risk by doing that as well. So for example, instead of doing $12,000 all at once into your investment account, you could do $1,000 every month for a year. And we just set it up where it would be automatically happening every month. So it's not something that you're actively making a decision on. And then on top of that, you don't have to worry about it. It's just running in the background. And we're not trying to time the market and hope that today was a good day or a bad day to start investing. So I want to talk a little bit about why it works and show you kind of the numbers behind this. I apologize if this is a little bit small, but hopefully you can kind of pinch and zoom in to see it a little bit bigger. But I did an example here of investing $500 a month into an investment account. Now, the numbers don't really matter here from a sense of like $500 or $5,000. We would still want to do this strategy regardless, but we're just using 500 as a nice easy number here. So let's say we have just the most turbulent stock market ever is what we're looking at here. We're showing kind of a more crazy stock market than what we usually see, just to help show you how this strategy works. So let's say in January, the market is down 10%. And so your money, your $500, is able to buy 55 shares because the price of each share right now is at $9. So 500 divided by 9 is going to get you 55 shares is all your money can buy right now. Then let's say in February, the stock price goes up or your investment strategy goes up 5%. Well, now your investments are worth $10.50, right? That's the new price per share. And so your $500, instead of buying 55 shares, it now can only buy you 48. So what you can see here is that you're buying more shares when the price is down and less shares when the price is up. And I think that kind of goes with the old adage of buy low and sell high, right? We're kind of doing that. We're buying more when it's low and we're buying less when the price is high. Next, we go to March and the market's down 15% here. So again, we're able to get things at a little bit of a discount. So the price has gone down to $8. And so because it's $8, your $500 can now buy 63 shares. So we can buy the most during this period when the price was at its lowest to take advantage. Then lastly, in April, we are up 20%. So we have a really great month, and our 20% raise in the stock price brings us to $12 a share. And that means we're going to buy the least that we could have bought during this 4-month period, where you're only going to be buying 42 shares. So if we look after this, you have 208 shares in total that you bought, and the average cost that you paid for those shares was $9.62. So you basically just multiply, right? $9 times the 55, $10.50 times the 48 to figure out what's the total cost for all of them, which would bring you to, if you're doing your math right, $2,000 total for that 4-month period, and then dividing it by the amount of shares that you bought during that time frame. And that's going to get you to that 962. Now, the other way of looking at it is your market average. And this is basically if you just take the average price over those 4 months. So the average market average is just saying what was the average price over the 4 month period. So the average price over the 4 month period would be these four numbers added together and then divided by four, which is going to get you 988. So essentially, because you did this strategy of dollar cost averaging, you only paid 962 on average for all of your 208 shares, even though the average price during that period was 988. So essentially, you got 26 cents off per share by doing this strategy versus, the average cost you could have paid otherwise. So that's where you're getting this big benefit here. So why do court reporters need to do dollar cost averaging? Well, number one is we see that there's a lot of income variability, right? You have good months, you have bad months. And sometimes we see that affects the investments that you're making in your portfolios because you're kind of aligning your investments with how your business is going. So we have a great month, you make a lot of money, you're probably going to want to do a giant contribution to your retirement account or to your investments. And then we'll stop doing stuff when things are slow and pick it back up, right? And it's kind of all over the place. But you run into that same issue where like the months that you did well and you added more to the market, were those the best months to add to your investments? Like, I don't know. Yeah, 50% chance, yes. 50% chance, no, right? So it's the same thing here where we want to just do a consistent amount every single month, because then it's going to follow that process of buying more shares when stocks are down and buying less shares when the stocks are up. So it helps with that variability in the stock price, and we do a little bit more consistent investing. Waiting game is kind of like I was saying, the opposite of market timing, where you're timing the market, you're waiting to choose when you want to add your money to the market. And if the market keeps going up, which is kind of what happened this year, right? A lot of people freaked out in April. They didn't want to add any more money to the economy. Recession has been, the big word in the news for the last year or so. And so you're waiting and waiting and waiting. And then we look at year to date, the S&P 500 is up 15%. So we wanted to just consistently add money into that portfolio instead of trying to wait and time it. It also gets rid of emotional investing for the same reason that these things are just happening automatically. You're not making any changes to your investment strategy. You're adding the same amount every single month. You don't care what's going on in the news. It's not going to change what you're doing in your investments. And then same thing with the cash flows and cash flow stress. You do need to make sure that you give yourself enough wiggle room here where you should never have to stop doing your monthly contributions because you had a bad month, right? So you do need enough wiggle room in your savings to give you that buffer where you can just keep doing this every single month and not have to worry about running out of money essentially because you had a couple bad months in a row. So don't start with anything too crazy here. So some things to think about if you wanted to think like, what's a baseline number I could do to start this? You could do something like 10 to 15% of, every payment that you receive, or essentially 10 to 15% of your income. That could be across multiple buckets of money, right? Across doing IRAs and brokerage accounts in different places, but somewhere around 10 to 15% is a great starting point. As I mentioned, you want to set the minimum monthly amount. So like I'm going to do $1,000 every month guaranteed. And then maybe you have a couple times a year where you do a little bit extra because you've built up extra money in savings. But we want to do something that's at least consistent every single month. You can quarterly averaging where you're checking your income every quarter to see what you're making and reassess this strategy, right? Am I making more nowadays? And I can increase what my 10 to 15% is. So maybe if you just kind of check in with yourself once every quarter, could be enough time to say like, okay, how's my income right now? Am I saving enough and doing the right strategy? Do I need to increase or back it down? Pay yourself first. This goes along with those automatic savings tools. It's way easier to just have this be like a bill that comes out on the first of every month and you don't get to make the decision. It just happens right away. And then that way, anything else that you have spending for the rest of the year, for the rest of the month, that's just your money to spend, right? You already did the hard work. You did the savings first. Now you get to benefit from not having to stress and worry about it, right? I already set money away, and anything I have left over, I'm free to spend if I want to. So where can you do dollar cost averaging? The short and sweet is anywhere. Any of your investment accounts, you can do this, your Roth IRAs, your traditional IRAs, your SEP or solos, depending on what you're doing there for your business, and then also a taxable brokerage account. Where we use the strategy on top of what you're doing with your income is actually if you receive some type of large sum of money. So if you get like an inheritance, or if you sell your house and you have some extra cash flow that you don't need anymore, and you want to add this to investment account, we want to follow the same strategy, right? You don't want to be just taking like $100,000 that you just got from inheritance and dumping it all into the market at one time and crossing your fingers that it was a good or a bad day to invest. So we would want to do the same process with something like that, where you have 100,000, maybe you take 1 year to get that all invested in the market, and you do, I don't know, $10,000 every month or $8,500 every month. So you spread out that risk over a year and you're not trying to time the market. So not only is this good for money that you're earning from your income, but it's also great if you have a large sum of money that you need to get invested and get into the market. So some common mistakes to avoid is waiting for the right time. A big one here is stopping during downturns, right? During April, what was the best thing you could have done during April when everyone was panicking about all the tariffs and all that? Added more money to your account, right? If you added money during the low in April, you'd be up like 25, 30% on those dollars. Those would be some of the hardest working dollars in your portfolio. So we got to remember, downturns are not good when you're in retirement. Downturns are great when you're still working and making money, right? I would rather put money in here than put money in here. So we got a downturn. That's an opportunity for you to add more money to your portfolio. It's not a time to start panicking and freezing whatever you're doing. On the contrary to that, investing short-term money, if you're planning to spend the money you're adding to your investment in the next 2 years, it's not enough time. It's not worth the risk. And I would keep that money on the sidelines. Checking balances daily. We don't need to be constantly looking at your accounts, or comparing to others is not going to be helpful for your, overall mental health as we think about your investing and your financial plan. What we want to do is start small, start with something you're doing consistently, gradually increase this over time, stay consistent. This strategy only works if you do the same amount every single month, and celebrate those milestones as they come up, right? You hit 10,000, 25, 50, 250, $1 million, right? We got to celebrate those big wins, and it'll help keep you motivated with doing this long term. What's your action plan? What's your homework from today? Calculate what's 10% of your average monthly income. What's a good baseline starting point for you to think about? Are you doing that right now? Could you be doing more? Decide on what type of account is going to be best for you to start this if you're not already doing it. Maybe you already have these accounts, but you're just making adjustments to what you're doing, and you're not trying to, wait till the end of the year, for example, to dump all this money into your retirement plan. But you want to start doing these things consistently, thinking about what account you want to start with there. If you haven't opened the investment account, get that opened up and set up. Start with something, right? Even if it's $50 a month, it's going to be helpful, and you're just going to get used to that money just coming out of your account, and you can slowly increase that over time. And that big important piece is the automation. Don't make this a stressful thing you have to worry about and do every month. Make it something that's happening consistently every single month, no matter what. You basically forget about it, right? You go check your bank statement and you're like, oh, look, I just made another contribution to my future, and I didn't even realize that it happened. So, of course, the best time to start this would have been yesterday, but the second best time is to start this today. So your future self will thank you for getting this set up, for lowering your average cost for your new investments as you add new money to these accounts. We'll start stockpiling and building things and growing these accounts over time, and it'll happen a lot faster than you think. If you have any questions, I didn't see any come in during this presentation live, feel free to post them in the comments, and I'm happy to get those answered for you. Otherwise, hope you have a great rest of your week, and I'll see you all next time.